Okay, everyone. Thanks for joining us today. The trading competition went great. We appreciate everyone's participation and feedback over the past few weeks. If you haven't yet seen the article we released on our competition retrospective, it's on Medium. Go check it out. It explains a lot about what we learned during the competition and some of the improvements that we're making before mainnet release. We're also going to discuss some of those improvements again today, and then some more in some future articles. Specific to the trading competition, on testnet, it was very successful. We were able to learn a lot about the limitations of our system in real time and figure out, ways in which that we could improve that. And we received quite a bit of valuable feedback from our users. We learned that the core system works as expected. We learned that the C value, our price level mechanism, proved to be understandable and it works properly, though it needs some improvement to fairly price the full range of options offered on Premia. We saved millions of dollars for our liquidity providers and for our platform by doing this testing on testnet during the competition and figuring out these limitations before we went live. So thank you everyone for participating. It was very successful. We also learned that the new UI is much more understandable and easy to use than the previous UI. So congratulations to our design team for doing so well. Thank you everyone for your feedback there as well. But we're going to keep trying to improve over time and keep making it simpler. One last thing that we learned is that we need to add some fail safes to make sure that liquidity providers aren't taking on unnecessary risk or taking on, putting a lot of collateral into a position that isn't going to reward them very much. So the way that we're doing this is that the minimum, we've added a minimum return on an option offered by the platform. This means that liquidity providers will not offer an option price that is underneath this minimum return. And this just ensures that our liquidity providers are fairly compensated for the risk that they're taking on, as well as the collateral that they're offering. Most option buyers won't notice a difference between the prices offered in testnet trading competition and post competition. It's mostly the options on the extremes of the spectrum, the highest strike prices and maturities that will be different. Moving on to the implied volatility oracle. So there's a huge difference between good enough and as good as it gets when it comes to using volatility to price your options. So there's, one thing we should clarify before moving forward. That's like implied volatility is not a real thing. Option prices are a real thing. Implied volatility is simply a simpler way to think about the future expected volatility surface for an option, given by the different strike prices offered and the different maturities offered by that option. And so one can, presume that the different strike prices and different maturities should be priced differently, such that if you were to plug them into the Black-Scholes model using, this volatility parameter, you would get a different option price for each of these combinations. So, this is different than something like Hegic, which uses a constant volatility for all options on the platform. What this means in practice is that any options offered away from at-the-money prices will be either underpriced or overpriced. This is why Hegic doesn't offer these options anymore. And then it also means that options at the end of your maturity spectrums will be either underpriced or overpriced. So, a constant volatility using Black-Scholes pricing is just asking for problems. So we've solved this using a three-dimensional surface. any new market is going to require a baseline implied volatility surface, or a baseline option pricing mechanism that can be reversed into an implied volatility surface. The problem is, the further is this baseline is from the true unobservable surface, the surface that we know exists but we don't know what it is. The further is your guess is, your baseline is, the more costlier it is for the market to converge to the actual number. This is the reason why we don't really see these markets in TradeFi yet. For, like, let's see, say like on Deribit, there's no options market for, let's say, Chainlink or Wi-Fi or Uniswap. And the reason is because the volatility is quite hard to price, and there's not an established market for this yet. So there's no established option pricing curve. So we've solved this, and we'll be bringing it to market with our mainnet release through our proprietary implied volatility model. This is simply another way to say our proprietary option pricing model, and we're going to provide it via an oracle. That's just a smart contract that any other protocol can query as well, and it will enable options markets with lower liquidity requirements than anything that exists so far. So this means that we can enable new markets for tokens like Chainlink and other DeFi tokens, and the options will be priced fairly for the full spectrum of options offered on day one, no matter how much liquidity is in there. So this oracle, we're going to be releasing an article on it soon, in the next week or so, and we'll be describing the option pricing method used just in, and explain to all these other protocols how you can start using this if you want to price options using it on your platform. Moving on to what's left before mainnet. The main thing is we're waiting for audits to complete. We have multiple audits going on by multiple different teams, Hacken and Solidity Finance. Part of that is we made some incremental improvements to our contracts after the trading competition to address some of the issues I previously described. So we're doing some iterative audits, audits on top of our previous audits to just audit the new changes. So make sure we leave no stone unturned here. We also are going to be updating our documentation. We're in the process of doing this right now, but we need to reflect all of the new changes to specifically the C value, as well as our option pricing through our new implied volatility oracle, as opposed to previously we were using a constant exponentially weighted variable for that. And then the last thing is we've made some discussions with the team as for what's necessary for launching this, and we decided that we're going to launch with caps on the pool at the beginning. The reason for this is we want, even though we did all of the testing in testnet trading competition, it's important to ensure on mainnet that all of these security guarantees still hold. And so we don't want to immediately ape in with tens of millions of dollars and then have our clients or have our users exposed to unnecessary risk. So we're going to be limiting the caps per user and per pool on launch, initially to $1 million per pool. There'll be 6 pools on launch, and then this will be scaled up as the pools fill, and we ensure that there's not unnecessary risk being taken on by liquidity providers, i.e. there's no exploits or anything like that. In addition to this, we've decided the tokens on launch, they'll be the same as the tokens during the trading competition: Bitcoin, Ethereum, and Chainlink. They'll all be using our implied volatility oracle for their option pricing, and that'll be ready as soon as we launch on mainnet. The last 2 things, we've added a basic vault. This wasn't available on the testnet trading competition, only the pro vaults were. The per pool deposits and everything. The basic vault essentially just allows you to choose which assets you want to deposit, how much you want to deposit, and your market sentiment, bullish, bearish, or neutral. And then depending on your sentiment, it'll show you the best pools that you can deposit your assets into, swapping first. So let's say you want to deposit 100,000 DAI into a bunch of, and you're bullish, you'd first swap some of that DAI into Bitcoin, Ethereum, and Link, and deposit into the respective pools. And your deposits are optimized based on the C level. So you want to keep the C level as high as possible, meaning that after you deposit, you're going to get the highest option prices uh, on that pool, which just ensures the highest returns for the liquidity provider depositing. It also has a side effect of ensuring that all of our pools converge to similar amounts of liquidity. So if a pool is under collateralized, or under liquidized, then this mechanism will incentivize those pools to add more liquidity over time. Moving on to layer 2. So layer 2 enables higher level of computations at cheaper gas prices. What this means is we can do a lot more on our smart contracts, and users pay a lot less in gas. So if we wanted to do some of these things on layer 1, it just simply wouldn't be possible. For example, some of the vaults we have planned, most of them actually, you just cannot do them on layer 1 because they're too expensive, and they don't make sense. Once you work in the gas costs, it becomes inefficient. But moving to layer 2, we're able to track things like liquidity provider and option positions at a per position level, which enables us to do quite a bit more with our pools and vaults to manage their risk and take on more advanced positions. Uh, Specifically, our vaults are capable of managing more advanced balance sheet risk on layer 2. They can figure out exactly their per position risk and hedge that if they want to. They can also calculate the total risk of their option portfolio, which enables us to move away from the queue system, and it allows us to use a pro rata allocation of pool rewards to our users in the pool that's equal to the actual risk that they've taken on. So there's a lot more that we can do on layer 2 that we're starting to think about, and that we're in the very early stages of developing. But long story short, we're very excited about layer 2 because it enables us to do a lot of the things we've been trying to do on layer 1 for a while, but been realizing that it's just too expensive. It just won't work. But on layer 2, it becomes very accessible. Per position action, allowing structured exposures to be created in real time at negligible gas. That's referring to some of our advanced vaults that have to manage positions at the per position levels. It can't be done on layer 1, but on layer 2 it becomes pretty simple. And then of course margins, if we need to track per position margins, for example, if we were using naked calls and puts, we got to do this on layer 2 in order to be able to track the risk of each option in real time. But the most important, the most fun thing about layer 2 is it enables us to create a peer-to-pool and peer-to-peer mixed marketplace. So you could think of this in two separate ways, where you go to the AMM and the price offered by the AMM includes the best prices offered on some peer-to-peer marketplace similar to Premia V1. Or you could think of it in terms of Premia V1, where you go to some order book and the orders on the order book include the best AMM prices spread across the order book. So, we've figured out ways to enable this, and we're, actively working on bringing this to layer 2 so that we can enable traditional order book market interfaces to leverage our existing liquidity on the platform and our AMM pricing model. So moving on, we're very excited about the future. We cannot wait to release V2 on mainnet. That's the biggest thing coming up. There's been a ton of work that's gone into this. 6 months basically of the slide says 12/7, but it's basically 24/7 work, because we've got a global team, and we're very active. Whenever somebody's sleeping, somebody else is working. So we've been putting in a ton of work over the past 6 months to bring this platform to you guys and make sure that we can offer the best option pricing in the industry for the widest range of assets in DeFi. And we think that we've done that, and we think that you guys are going to love the version 2 platform, and we just can't wait for the DeFi community to start taking advantage of it. We're also very excited about our implied volatility oracle, allowing any platform to price options fairly with a low liquidity. We're excited to see what other protocols start building on top of this and start using option pricing within their platforms. As well as this, there are a lot we can do with capital efficiency, especially once we move into layer two. We can start to make our platform more capital efficient, and we can start to focus on how we can allow users to do more with less of their capital. And so there's a lot of exciting things that we're working on there, and that we're looking forward to. One big thing is, with the release of V2, in addition to Premia liquidity mining, which will be competitive to market APYs within itself, uh, the yield generated by our vaults from selling options, to the market, I think will be competitive. And so this, in terms with, or this coupled with our Premia liquidity mining, should result in some very exciting yield produced by our platform, which should expose everything that we've been building to the DeFi community at large. And yet, of course, we're very excited about layer two for all the reasons that I discussed previously. It enables us to do all of the things that we've been wanting to do and that we've been thinking about and that we've been researching, but it has just been too expensive to do on layer one. So yeah, V2 platform or layer two platform will be crazy. It'll be very exciting. The last thing, we need your guys' help. So right now, the documentation's a little outdated, but it will be updated, over the coming week. We need you guys to read the current documentation and the new documentation and tell us what makes sense and what doesn't make sense. Let us know if there's anything that we need to improve on. Also, play with the system. Right now, it's available on testnet on Rinkeby still, but when we release on mainnet in the coming, week or so, weeks, play with it. Let us know if there's anything on the system that you don't understand. Let us know if there's anything that's missing or something that's just too much bloat. We're happy to hear your feedback and iterate on the system. The user experience of Premia is our number one concern. Included in that is offering the best option prices for the widest range of assets, but also we need to ensure that we have the simplest, easiest to use options platform on the market, so that when users want to trade options, it's very simple and easy for them to do so. They don't have to figure out, a complex interface. And of course, we're always available in the chat. Ask us questions if you have any, give us your feedback, and please tell your friends about Premia. V2 platform is launching soon, so we want to have a good turnout for that. So let people know that V2 is launching soon, and let them know that, we're going to have the best option pricing in the industry. So I thank you guys for joining. We're going to answer some questions in the community chat. Let me open those up. So I see.
When?
Yeah, go on.
No, nothing. I was just scrolling at the questions.
Oh yeah. I see Algorithmic's question about the market re-rating and stuff. Unfortunately, we're not really at will to talk about that. We don't really know. Obviously, it's like we're releasing V2 on mainnet, and when we release V2 on mainnet, that will expose Premia to a new set of eyes and a new set of yield farmers and a new set of option traders, and it should show the world that there's value in our ecosystem and the underlying token. But as far as what the market's responsible to that will be, that's impossible to know. What are the internal estimated growth expectations after V2 release? I guess it depends on what you mean. So as far as growing the team, we're going to be careful to grow the team slowly as necessary. We don't want to be adding a million people to the team as fast, as quick as possible, and then realize we don't need people or that people are working inefficiently, whatever. We have a very strong, very efficient team, and we want to keep it that way. So we're going to be adding people to the team, as it makes sense, as we need them, and people that add to that ethos of the ecosystem that we're building. As far as growth, after we release V2 on mainnet, we'll be starting with a lower pool cap and releasing that pool cap or updating that pool cap higher over time. So we expect that as we increase the pool cap, we'll get more use of the platform, we'll get more liquidity on the platform. And moving into layer 2, there's a lot we can do as far as growth of things you can do on the platform, the value offered by our vaults, and other products. So as there's a lot of growth expected over the next couple of months, 6 months, year. We have no plans to stop moving at the rate that we're moving. We're just going to keep going faster at this point. During V2 launch, hopefully there is massive marketing planned. Okay, so this is more up Coins, Ali.
Yeah. So we have a good amount of marketing planned around V2 with some external marketing partners, as well as there's a question further down the line about some Chainlink stuff that we had briefly talked about in the last article that we put out and community call. And we do have some stuff that's in the works planned with them as well that will kind of coincide with our V2 launch in regards to like having more panels and having co-marketing with them. So being able to reach out and get exposure into their community will be very helpful, I think, in the beginning, being that we're starting with traditionally BTC and ETH pools, and the only altcoin besides Premia that we'll have is Link. Other than that, we plan to continue doing that. And then I've talked about it before, but we're with the Fortune stuff that came up, the people pleaser things kind of got pushed back a couple weeks. But it's kind of coinciding nicely with how V2 is lining up to launch. It'll probably come just after the launch of that. So that'll be another kind of big push we have on our end in the marketing front.
Cool. And of course, we also have our existing marketing efforts that we've been doing for the past couple of months. They'll continue to go, and they'll just ramp up. The thing about marketing is you need a product, and as soon as we have something on mainnet that people can use and that they're excited about using, then we can ramp up marketing, and we can the type of marketing that we can do changes, because we can say, hey, this is a platform that exists, this is what you can do on it right now, rather than this is what you can do in the future. Andrew, go on.
I was just going to say, I think we'll be spending a lot of time highlighting the different features, because there's a lot to come with V2. Those of you that participated in the competition kind of got a hands-on with some of that, being that there's different ways that people will be able to earn yield. There's elements to it that may feel reminiscent to lending, in a money market to people and the type of yield that they get. So there are a lot of ways that people can earn using the platform that I think will entice people. Because from the way that I look at it, the ending of incentives was the maybe biggest detriment to what was happening with Premia in the beginning. So the reintroduction of those, I think, is going to reinvigorate a lot of interest.
Cool. Andrew asks, is the Chainlink Volatility Oracle launching with V2, and how much, if any, external 3D third-party value do you anticipate this Oracle to drive to Premia? Okay, so there's two notes there. We're in talks with Chainlinks about helping to decentralize the Oracle. When we launch it, we'll be decentralizing using a multi-sig that's owned by Premia core members to ensure that it's secure. But there still are some decentralization concerns. So we're trying to figure out the best way to do that long term. It's most likely going to require using something like Chainlink V2, which is taking advantage of their decentralized Oracle network, or building a decentralized Oracle network specific to this iVol Oracle ourselves. But when we launch, we'll be maintaining it ourselves, just to ensure that it works for our use case and that it does what it's intended to do. And as the use case grows and as more people start using it, then we'll start building out this decentralized Oracle network for maintaining the Oracle and decentralizing all of the pieces of it. So, specifically to answer that question, on launch, it won't be maintained by Chainlink. It'll be maintained specifically by Premia. Just using, we'll be using the same exact processes that Chainlink uses to make external APIs available on chain. The only thing is it won't be maintained by a link pool provider or a Chainlink provider because, we looked into it and it's the method that they're currently using isn't quite decentralized enough for us. So we need to figure out a more decentralized method of doing that. Do we anticipate this driving value to Premia? Yes, of course. We've put a lot of time and effort into figuring out how to accurately price options, how to fairly efficiently price options for these new DeFi assets. And we believe we've come to some solutions that the market will be very happy with. And so once the market is able to use these and is able to actually fairly price options on these newer assets that weren't able to have liquid options before, I think it will obviously drive value to Premia as people realize the research that we're doing is valuable, and that the tools that we're building are valuable, and that we have no plans to stop. We plan to continue moving the options platforms forward on Ethereum and in decentralized finance. And we just continue to do more research and figure out how to move option pricing forward. Wayne asks, what are the decentralization concerns about the Vol Oracle? So it's kind of what I just talked about, where, so essentially the issue is you need multiple different nodes to produce a value, and then you need them to produce it securely and verifiably in a way that you can have each of them say, yes, we produced the same value. And then that value, if it's all the same between all of your different nodes that are verified, then that value gets pushed to on-chain. So current decentralized concerns is that Premia will be maintaining all of these nodes on launch. So you could say that there's a decentralization concern, but over time we'll be mitigating this by allowing others to run nodes, whether it's through Chainlink or through our own Oracle process. We'll be ironing out the details over time as we figure out what the market is looking for, as well as what's the best decentralized options available for these types of oracles. Andrew asks, how will link tokens accrued via the Oracle be accounted for in Treasury, and will the ex-Premia holders have exposure? So there won't be link tokens accrued by the Oracle on launch. It will be made available free. So basically, it's just a contract with view methods that anyone can call those view methods and can get the option price based on the values stored in the contract, and the values stored in the contract are updated hourly or similarly, so that they always provide accurate option pricing based on the updated volatility surface. So there won't be link tokens collected by the Oracle on launch, but perhaps over time, as we decentralize it and decentralize it further and make this infrastructure more widely available, then we'll think about ways that we can accept payment for it. Primary, there's off topic. Any comments on Hegic's new V888 release, specifically zero loss staking pools? Yeah, okay. Their zero loss staking pools are enabled. It's really just they take some percentage of your premium and they use that to off-chain run their own delta hedging. And it's basically you're trusting that their delta hedging is good enough, and you're trusting that they're going to pay you back at the end of the day. It's not decentralized, and it's not pretending to be decentralized. So it's not something that we would ever look into. On layer 2, we're looking into doing very similar things, but the delta hedging we aim to do will be fully decentralized. There won't be, this centralized element which Hedgic has, where they take your premiums, they do something off chain with it. You hope that they're doing something, and then they bring it back and say, "Here's your no loss profits." Uh, I mean, it's cool what they're doing, but it's not decentralized, and we don't think it's the future of decentralized finance. So if we have any more questions, it doesn't look like we do. I think we're going to wrap things up here then. Of course, if you have any more questions, feel free to ask them in the general chat or in the community call questions for next time. Oh, Wayne asks, how does V2 handle market impact when someone buys a lot of out-of-the-money options? Okay, so let's say somebody buys a ton of, well, there's two ways that our market handles this. So you have to take into account the C value, which if somebody, purchases a bunch of options at the market rate, then the C value will rise, right? Because they're taking free liquidity out of the market, which means the utilization rate will go up, and that means the C value, will go up to account for the difference in supply and demand. So this means, that the next option purchase on the platform will be more expensive, unless a liquidity provider deposits liquidity to then take advantage of those increased prices and brings liquidity down. As far as our implied volatility oracle, that's something that we're looking into adding to our oracle. Specifically, we have plans to add options priced on premium to the oracle, such that we can take into account. So for example, currently the oracle is mostly based on Deribit, and we will update this over time. But essentially, we're currently taking the implied volatility surface produced by Deribit options and manipulating it in a way that we can bring it on chain, and then making it available, manipulating it, the ETH implied volatility surface in a way that it works for Chainlink. Okay, so if somebody buys a lot of out-of-the-money options on the premium platform, those options, the implied volatility of those options will be sent to our, our data stream, which is used to produce the surface from our oracle. The data stream will take into account those trades, and we'll see that somebody is willing to pay more for these options that are out of the money, so that will update the implied volatility surface to be slightly higher at that point on the curve. So it would work similar to same thing if you were buying option. If somebody were to buy a lot of out of the money options on Deribit, the same exact thing would happen, where we take the data in from Deribit. We see that these options have been priced at this updated price. We could say, okay, now our service needs to be updated at that specific location. We update it to the new price, and we interpolate the new surface, push that to our oracle, and now these prices are available on chain. So to more succinctly answer the question, if somebody buys a lot of out-of-the-money options, it will cause the price of all options to go up, and it will also cause the price of out-of-the-money options to go up slightly further. This is exactly what we'd expect, by the way, and what we want and what we designed the system to do. If you think about it, we designed the system to respond to supply and demand for specific options, such that we can price options efficiently. So if somebody were to buy a lot of out-of-the-money options, then you would assume that the supply for that is dropping and the demand is rising. So you'd want to update the option price accordingly. Okay, I think that's all of the questions for now. So we're going to wrap it up here. Thanks to everyone for joining us. We look forward to seeing you guys next month. And of course, we look forward to seeing you on the platform. Please tell your friends. Please look at our documentation and let us know your feedback. And we look forward to seeing you in our chat.